We have a few new members around the table, and I would love to go around and see if you could please introduce yourselves. Wait, hold on. But we want to do the roll first. Please start. Chair. Here. Comptroller's Office.
Present.
Public Advocate's Office.
Present.
Borough President Manhattan.
Here.
Borough President Brooklyn. Borough President Queens.
Here.
Borough President Staten Island. Borough President Bronx.
Here.
International Brotherhood of Teamsters.
Here.
Transport Workers Union. District Council 37.
Here.
We have a quorum. Sorry, go ahead. Okay. David?
Okay. Welcome. Thank you for having me. My name is David Howlett. I'm a representative public advocate. I have distinct pleasure of saying this is my first meeting, and I'm looking forward to participating and hopefully adding something to the dialogue as we go along, not just today, but in future meetings. Briefly, I'm industry experience. I also have trustee experience in that in 2008 I was appointed by Governor Patterson to Insurance Fund Board and elected chair of the investment committee by my peers. I'm also a SUNY Construction Fund board member, and I have less construction industry experience, but just shows you that I can stretch for matters that I may not be entirely familiar with, but I will certainly do my best to help the NYCERS system going forward.
Welcome.
Thank you.
Barry?
Good morning, everybody. I'm Barry Granchik. I'm Helen's deputy. Born and raised in New York City. I won't tell you how old I am, but you can Google that. I served previously, started my public service career with Assemblywoman Nettie Mayerson, then went to Governor Cuomo's office where I served as an ombudsman for several years, and then Claire Schulman hired me to run her office. I was there for 10 years, and from there I stayed with Helen for a little while and then was elected to the New York State Assembly, representing at that time the 22nd District, which was mostly downtown Flushing and the surrounding communities. I was in the private sector for 4.5 years, and since January of 2010, I have served as Helen's deputy. And it's great to be here. For those of you who know Hugh Weinberg, which is just about everybody in the room, I regret to inform you that his mom passed very early on Friday morning, and that's why he is not here today. And unfortunately, I don't have any details, but I presume that all the details are in Cleveland or thereabouts, because that's where she lived, and I expect to see him back in the office on Monday. Thank you for having me.
Welcome. David, did you briefly want to just tell us about Stephen? Or is
Want to introduce Stephen?
Yeah.
Also from the Public Advocate's Office.
Also from the Public Advocate's Office?
Stephen B. Martin, counsel for the Public Advocate, alternate designee as well.
Great. Thank you. Larry, over to you.
Okay, does everybody have their monthly performance package? Since we have a long agenda, I'll go pretty quickly through the slides. I guess the right place to start is probably page 3. It's the GDP, and you can see it's slowly working its way up. The biggest problem, as we all know, is unemployment, which you can see on page 6. There's the weekly claims. The good news is that on a trend basis it's going down. The bad news is it's still very high. As is page 7, the unemployment rate is still in excess of 8%. And until that gets back in line, we're going to have a problem. I would tell you on page 10 is a flashing yellow light. It's Architectural Billing Index. As we all know, it's a leading indicator. It's flat for the last couple of months. That means corporate America is being cautious building new facilities. One of the problems, and I won't walk through the slide, is housing sales and construction remain in depressed levels. Prices still going down, although bottoming, you'd like to hope. But again, that's one of the engines of the economy. Until that gets sorted out, we're not really going to go very far. If you jump to page 22, You can see the VIX, which is volatility in the United States markets. And as we discussed before, markets have calmed down since the ECB injected a couple of $1 trillion into the European banking system. As you can also see, it's kind of picked up in the last couple of weeks because the European situation is not resolved. It's one thing to put liquidity in to provide liquidity for banks. It's another thing to solve debt problems. Debt problems are much more long-term. There's a lot of countries in the euro, and it's just going to be a problem for several years to come, and it's flaring up again as we speak. You can see page 23 is the yield curve. The white line is the current yield curve. You can see again it's low levels, very short, very depressed levels for the year 1, 2, 3 year rates. The Fed's ending Operation Twist in June. All eyes are on them as to what they're going to do. My personal belief is they're not going to do much. They're a little bit in wait-and-see mode, having done a variety of things. If you look on page 24, you can see the 10-year Treasury. It's basically going back down because people are, again, worrying about a flare-up in Europe. So it's back below 2%. It's about 193. Again, on page 25, the Fed's trying to encourage risk-taking. Hence, the red line, which is high-yield spreads, going back down. And similarly, the stock market going up. The good news on page 27 is corporate profits keep going up. Margins might be contracting a little bit, but the growth rate is still pretty good. You can see the PEs on page 28 for the U.S., IFA, and emerging markets. The more interesting page is probably page 30, which shows pretty dramatically that since the ECB's move in mid-December, the markets have gone up. And similarly, you can see less dramatically that since April, again, things have gotten a lot more choppy. Volatility is back. That was the VIX. And we expect it to continue to be volatile for a while. All that said, if you roll forward to page 32, you can see the 12-month value of NYCERS. It's up around $41.7 billion. Again, it's net of distributions. So I think we've sort of gone through the very, very complicated fall pretty well, and we're starting to make some money again. I would have you flip to page 40. Just to show you again, we're in April now, but in February, go back to that chart on the markets. February was a very good month. The U.S. markets are up about 4%, international markets are up about 5%, the high yield market was up 2%. And a glimpse to the future, which is on page 41, which is the next board meeting where we have the March results. The markets continued to go up. So the stock markets in the U.S. are up about 3%, sort of down a little bit internationally, and pretty much flat in the fixed income land. If you go to page 36, you can see the current asset allocation, what's sort of over and under. And again, this is the new adjusted policy weights. We're pretty much within most of the bands now. We're a little under in fixed income, core plus 5, and tips. Opportunistic fixed income, we're working on the contracts. Cash is down to 1%, but now, as of now, it's 0. So it's all been put back in the market. We're a little overweight U.S. equities. That's because the market moved up. So that's why the good news is we're overweight. But at some point we'll rebalance. If you go to the next page, 37, you can see at the top part, you can see the actual total equity, total fixed income, total assets, and you can see the adjusted policy weights. So again, we're a little outside the range in U.S. equities. In total equities, we've lightened that up to get ourselves back in the range. It's kind of a work in process. But this month, April, we sold about 0.8 in IFA to pay some benefits. So again, we're rebalancing to pay the benefits to get ourselves back in line. What does all that add up to is on page 42. If you look on the far left, you've got the 1-month return, wrote about 3%. All the asset classes in February made money. The year-to-date numbers now up about 2%. I think we went up in March and probably down a little bit in April, so my guess is we're probably about flat to this number through middle of April. And we're just going to have to see where the markets go between now and the end of the fiscal year. Virtually all the managers are getting themselves back in line. Again, there was a little bit of underperformance in the choppy fall, but people are actually creating value now for us. And the indices, the passive is all doing what it's supposed to do, which is follow the markets. So good month in February, probably a good month in March. Some of the March up is offset in early April. And we're still working on getting the rebalancing done for the new asset allocation. So that's the month. Anyone has any questions on the numbers, happy to go through them. Seema, is there anything you'd like to point out in equities?
No.
Martin, fixed income?
No.
Barry?
No.
Yvonne?
No.
There you go. Okay. So that's the quick overview of the month. All good? Okay. Sorry? No, I'm afraid. I've been working on it. It's not for lack of working. If you have some, send them in. Equal opportunity jokes. So, we have today a presentation by John Bright of our staff. John, why don't you move up somewhere? Yeah, why don't you sit right there? Sit where John Zacone would be. And you might give everybody...
Everybody should have one of these. Does anyone not have one of these nice color ones? You need one? Yeah, it's in the fact book as well, but in black and white. Yeah, so these are the color version.
Do you want to start by telling them your background?
Sure.
Thanks.
I was a physicist until my mid-30s and then went off to Wall Street. Eventually ran the risk management groups at a few different firms. And since retirement, have been coming for the past 6 months, I guess, to Bureau of Asset Management to help look at the risk. So I think my title was Risk Advisor today.
That was an understated background.
Yeah.
Modest man.
Okay.
Well, that's all right. That's all right.
We're going through the various systems making this presentation. I've already been to the firemen. And the feedback I got is that I'm a very depressing person. So to inoculate against that, let me just say at the outset, the job of the risk manager is to look at what can go wrong and only what can go wrong. Yeah. And I am sure there are many delightful things that can happen to the portfolio and the markets and the economy, but that's not my field. So hopefully you are all immunized against my somewhat depressing personality. The point here is what I'd like to accomplish. I'm not going to tell you today anything you don't already know. The portfolio is fairly simple in its exposures. And so the point is not to give, there may be an occasional insight, I hope, but the point mainly is to introduce a framework for looking at the risks of the fund. So as we diversify into new product areas, are hopefully eventually have the flexibility to do things other than typically what we've gone into, we'll have a framework for analyzing new things for which our intuition is not as well developed as the inequity markets. And in looking at the risks, I want to look at two things. One is the sort of traditional risk management of looking at the volatility of one's returns. But equally, want to look at the long-term, that's sort of the short-term risk, but also look at the long-term risk of underperforming the assumed rates of growth. Because there's frequently a trade-off between them. You get rid of volatility, you also get rid of returns sometimes. So I want to look at both of those. So we'll look at some short-term risk measures and also at some long-term risk measures. And one thing I'd like to do throughout the presentation is just highlight what I consider the shortcomings of statistical measures. They can be very useful sometimes. They can also lead one down the garden path. So my hope is to illustrate, as I'm going through this, where things should be taken with a grain of salt. And the risk measures we're going to look at are simply the market values. What do we have in various asset classes? Both where we look at what is called equity is in the equity bucket, what's called fixed income is in the fixed income bucket, but also where we look at the correlations among assets over the past few years, where we find many things that are called equity have behaved an awful lot like equity, and so we'll look at the market values that way. Then we'll look at value at risk. Value at risk is essentially a statistical measure of the volatility. It's fallen into some ill repute because of the fact that virtually every broker-dealer who lost tens of billions of dollars in 2008 was publishing value at risks on the order of $100 million. So it does very little to tell you about the potential for an enormous stress in an unusual market, but it is a decent measure to the extent that the future is like the recent past. It gives you a good measure of what the month-to-month, day-to-day, week-to-week volatility of the assets in the fund will be. And then I'll turn to stress scenarios for a more long-term view of what can happen, both the 10-year stresses and 40-year. All right, then we have a colored pie chart, which is the current allocation of roughly 3/5 in equity, a quarter in fixed income, and bits and pieces in other stuff. If we look at the correlations over the past 3 years, then we get to the next pie chart, where if we take everything that has correlated very strongly with the public equity markets, our equity exposure becomes really 2/3 of the portfolio. And fixed income shrinks because two things that are nominally fixed income, convertible bonds and junk bonds, have to behave an awful lot like equity.
John, there is a significant chunk of our public fixed income and investment grade corporates which also act like equities. Did you not separate those out?
There are two things. One is what we know in our hearts will behave an awful lot like equities, and I'll get to that in the long run. The other is what the data show for the past several years is having a high correlation. And corporate bonds, while they showed a positive correlation because of spread widening when the equity markets tanked, did not show a high enough correlation to be put in that bucket. If I were doing, what I think in the long run intuitively is the case, I would say that corporate bonds and even treasury bonds, because in the long run we have a fairly short maturity, roughly 5-year duration, so we'll roll the portfolio. If equity markets go up, interest rates go up, and eventually you reinvest at higher rates. So you'd see that sort of correlation with long-term growth. But the data simply did not show a short-term correlation, so I left it out there. And also for private equity. And private equity, because of the nature of their accounting, shows virtually no correlation with anything. There tend to be lags in reported P&L. But in our gut, we all think in the long run it's going to behave sort of like public equity. So for the purposes of this chart, we're looking only at the correlations we saw in nature for the past 3 years, not what we all may think might happen. I'll then turn to value at risk, which weights, effectively it weights what we have in various asset classes with the volatilities of those assets that we've seen over the past 3 years. So we look at a 3-year horizon, or data over the past 3 years. Look at, and I should mention, we have chosen to do value at risk using, for our data, our actual return streams that we get from Bank of New York, and doing the correlations and statistics on the returns of the various asset classes. There are other ways of doing it. One could look at a securities database and map things to how various securities behave, and we will add that in the future. The resources within asset management are the computing resources and database management resources are limited at the moment. We need to grow them in order to be able to do the more sophisticated analysis. We need to build a securities database, have more computing power, etc. But with what's available right now, we can, with the aid of a very, very talented Excel programmer in our office who's done an enormous amount of work, we can produce value at risk and other measures in-house by looking at the data we get from Bank of New York. And I would add that we very much value having consultants who can do things to help us. But I think it's important, particularly when you're trying to explore new areas you might want to go into, where you don't even quite know what questions to ask, to be able to play with the data, to experiment. And time might make that hard. It's best to be able to do that in-house. Once you've figured out exactly what you want, then you can industrialize it with a vendor or a consultant.
Can I push back on that a little bit?
Yeah, sure.
We have seen a very robust presentation from Callan on this topic about a year ago. I'm a little surprised to hear you say, so do I take it that there hasn't been collaboration on this deck?
No, we
Callan?
Yeah, we had reviewed and talked about it last week, Rodney, and...
After the deck was done?
Yes, after it was done, yeah. But as we talked about it, I think, we viewed this was a sort of top-down view that sort of talked about risk management overall, bringing something more to the table, actually, that I thought we had talked about last time around. I think the way we had approached it, I'm going to defer to John on the value at risk discussion because that's out of my area. But I'm not sure I had actually thought about the work we had done, sort of a value at risk type of measure. I often think of that more from a bottom-up security level as opposed to a top-down asset allocation level. But so nonetheless, we've taken a look. We talked about this, and I think a lot. I didn't think we viewed this as John said at the start as groundbreaking with new information as much as a real review of things that led to many of the same conclusions we talked about last time around.
Okay, let's come back to that. Please keep going.
But one thing I would stress is all these statistical measures, the answers are heavily dependent on what time period you choose, whether you exponentially weight the data, whether you take raw data, how you map things. If you haven't done it yourself, once at least, you don't even know what questions to ask of someone of, what assumptions, because there's a whole host of assumptions that go into any analysis. And there's a need in my mind, a very strong need, to have enough expertise in-house so that we're able to know what assumptions are going into something we're being shown. And people always disclose their assumptions, but you don't necessarily even understand them unless you've tried to do it yourself at least once. Right, the next slide shows the value at risk. Total value at risk for NYCERS is roughly around $2 billion. And what does that mean? It means that you should expect in at least 1 month every 2 years that the fund would lose $2 billion or more in market value.
That's 5%.
Yes. That's roughly the likely, and in fact it's happened, so it's
In 1 month?
in a month, yeah.
And that's based on the data that we have.
Yes,
Right.
so it's just looking at our returns month by month, looking at the statistical distribution, and it tells you that roughly 1 month out of every 2 years you should absorb a loss of that magnitude. You should expect to. Could be worse.
With the current policy portfolio?
Yes, with the current portfolio. We're just taking the portfolio and projecting it out through time. What's interesting, I think, is that the contribution of equity to the value of risk is, in fact, $2.2 billion. So I wanted to show a pie chart, but I don't know how to do a pie chart where one slice is bigger than the entire pie. So we did it this way instead. Most of the stuff doesn't contribute much of anything because they're very small or because they don't correlate particularly well with the equity markets.
Can I ask a question now?
Yes.
2008,
Yes.
the markets were very far down,
Yeah.
beyond this 5%.
Yes.
And no asset class performed well. So is that an anomaly?
Long bonds before really well.
Yeah, Treasury bonds.
The core plus 5, the Treasury portfolio did about 20% that year.
Yeah.
And long bonds would have outperformed those by a lot.
Correct.
But we're looking at 3 years of data going back from February of 2012. Yes. So we only go back to 2009 for this analysis because we're looking at recent returns. If we dial back and included 2008, these numbers would look worse. But we would still have seen the fixed income portfolio bringing the overall risk down because of the flight to quality. When the equity markets tank, when credit spreads widen, everybody wants treasury bonds, and they rally enormously. And this illustrates also, I think, one of the limitations of these statistics, because what this is telling us is treasury bonds reduce our risk. Well, it's hard to see that being true going forward. Risks are already essentially zero. They don't have much room to rally anymore. So to the extent that the treasury portfolio diversifies, it would be in a bad sense, where equity markets go up and interest rates go up, so treasuries go down, so it detracts from it. It would be, it's not what the statistics tell us, but that's what our guts would tell us.
Mark?
Yeah, but, and John made the point again that I was going to get at, just as a reminder, I think at the start, to your point, Pat, one of the things that John said, I think is true, is the limitations, to some extent, of the predictive ability of this, in terms of predicting what the possible losses are. In the case of 08, in fact, markets correlated to a degree that no matter what, as you said, John, the value risk models were used by institutions did not predict. In fact, the losses were significantly worse. And so the limitations on the predictability of this is something I think is important to keep in mind.
And partly it's markets can move more severely, but also value at risk doesn't tell you anything about what was happening, which is we were mismarking billions and billions of dollars of inventory, and when you correctly value it, you're suddenly going to take a huge loss, which was a big part.
We weren't mismarking.
No, we being Wall Street, yes.
The other we.
The other we, yeah, my former we, which I renounced, yes, of course.
Sean, is this Monte Carlo based, so there's a
No, it's
10,000?
historical simulation.
Oh, right.
They're
So
historical.
it's very basic.
Yeah, but a Monte Carlo based on the same data would be equally basic. It would appear more compelling because you generate many, many data points, but you're generating them out of a distribution which was only the previous monthly. So sometimes the sophistication of Monte Carlo is illusory. It gives you the impression of having done something with more statistical weight, but it can only have as much statistical validity as what went into it in the first place.
But if you did a broad spectrum of Monte Carlo, you might come out with something worse than this.
Well, no, not really. No, because the data that went in is the previous 3 years. If you took daily data instead of monthly, it would actually come out a little better because you suppress many of the correlations. The longer the time period you look at, I mean, the obvious example is daily equity data. You know, for the past several years, we've had something bad happens in Europe, so our market responds, and then Tokyo responds. Well, Tokyo's in another day. So, yeah, you can get more data points by looking at daily data, but you obscure some of the fundamental correlations of what's going on. So we chose to look at monthly data to ensure that we capture all the correlations. We get slightly better statistics going to more data, daily data or weekly data, but the trade-off is you sometimes obscure true correlations. So it's a matter of taste, which way you go.
So John, one of the differences between NYCERS portfolio and that of an investment bank is investment banks move lots of things around very, very fast, right? So they can actually change this number a lot.
They can change a lot. The investment banks still make most of their money in fixed income and currency trading. So you would see huge contributions to the risk from there and far less than investment banks are not equity investors per se.
My point was, if they want to change their risk portfolio, their risk appearance, they could do that over some number of days.
Yes.
We can't do ours over months.
Right. So no, we need that long-term view. You know, a daily bar means something to an investment bank. So they tell you, "Oops, you know, we got some trade on. We should go look at." It's not going to be particularly meaningful.
Right. So for us, for instance, to buy or build a daily system, what do you think of that?
No, it's pointless. Yeah. The only reason to do it would be more data gives you better statistics, but on the other hand, you obscure certain correlations. We looked at the trade-offs and decided monthly is best.
So then how do we use this data? Right? So I hear Mark saying that you sort of take it with a grain of salt, and you're saying that it's only 3 years worth of data, and so how do we implement it? If it's limited in its robustness, if you will.
Yes, and it always will be. And you could look at many more years of data, but then you look at different economic cycles, and it's not clear that that's valuable. What you do is you look at it to inform intuition and judgment, but not to replace it. What you need to do is sometimes the statistics can reveal something that you were not altogether aware of, and then you dive in and say, do I think this is really true or not? But it can never replace that. And I remember when I first went to Wall Street in the 80s, the S&Ls, Volcker had raised rates, S&Ls make fixed rate mortgage loans, they fund at the short term, rates went to the moon, and they just got crushed. They were paying out far more in funding themselves than they were earning on their mortgage assets. And there was a wave of products that came out from detailed statistical analysis of what had gone wrong and the volatility of short-term rates, and most importantly, the volatility of prepayment rates of mortgages, which for the past 30 years before then had been extraordinarily stable. So the product everyone entered into was swapping. They would take their fixed coupons of their mortgages and take the amortization of the mortgages, which had been incredibly stable for the longest time, and they swapped that into a floating rate. So it matched their liabilities, the regulators were happy, they were happy, everybody no longer had this interest rate risk. Since I'm telling the story, you know it ends in tears. Of course, what happened is the world changed something. All the statistics meant nothing in the end because prepayment rates went to the moon. And now they still have the swap hanging out there, and they're paying a big coupon on that, and they're replacing their mortgages with much reduced rates, and so they lost twice. And actually, a couple of S&Ls went out under. So the moral of that story is the statistics is useful in guiding your eye, but there's no free lunch. So if the statistics tell you you can reduce your risk and still have good returns, what they're really telling you is you can substitute this risk that you decided you didn't like because it's just what happened to you with some new risk you hadn't thought of. And I think our job, after looking at the statistics, is to think as hard as we can about what is this new risk we didn't think of that we're now taking on. Once you identify it, then you decide whether you think it's worthwhile, but you don't blindly go in on the basis of the statistics. I don't know if that answers it. All right, so that's fire risk. The next page is to show we have a vendor. We've been using, Bank of New York uses these guys, and they have an overlay on top of their system. And we may eventually, now that we've done it ourselves and we can tie our numbers to theirs, we may eventually go over in production to using this. And this just illustrates that you can drill down and look at the value of risk manager by manager and see if there's anything interesting. Is there a particular manager who seems out of line in the amount of risk he's taking? None of them do. But so this is there just to show that in the future we may make this more of a production engine by using the vendor. All right, then we get to the long-term views of risk. And here 2008 will not come. And I picked scenarios. First we have the actuarial scenario of 8%. And the next scenario, personal favorite of mine, is we turn into Japan. The whole world turns into Japan. So you just have a prolonged period of no growth and equity markets going nowhere. Then we have the stagflation period in the 70s. We just assume all equity markets around the world look like the S&P then. And then finally, the aughts. We had two debacles, essentially. We had the tech bubble bursting early in the decade and the finance bubble bursting later. So we have equity markets tracking that. For fixed income, we just very naively assume it toggles along. You could put in more sophisticated modeling of fixed income, but it's not going to change this. The portfolio as it stands is so equity-driven, that's doing the heavy lifting in this scenario. All right, and then we have the colored picture showing the scenarios.
John, could you go back to page 9 and your last bullet point? We use the same returns regardless of the scenarios above?
I'm sorry, the same returns.
I just want to make sure I'm understanding the last bullet point.
Oh, we're now going to say that private equity, private real estate, over the long run, are somehow going to track equity. So they're going to track whatever equity return we're using in the three scenarios above, but we are going to give them some credit for the expert management by giving a couple hundred basis points of extra return to those areas.
But go ahead, please, no, Larry.
Is that a fair assumption in terms of how they correlate?
Well, the correlation is essentially nil over the short term. But Larry is more expert in private equity than I, certainly. I don't disagree. But I think of private equity as being leveraged public equity, or behaving rather like leveraged public equity, with market policies that allow you to smooth bumps along the way.
And John, isn't that smoothing the reason for the low correlation? I mean,
Well, it's that.
It's also economic correlation that's very high.
Yes, and it's partly that, it's partly just the way they report earnings with lags. It's very difficult to line them up with everyone else. Yeah.
So you have Japanese equity markets where you have a period of economic stagnation and deflation. You have economic growth and high inflation, and you have the dot-com bubble, and these relationships don't change. And fixed income,
Relationships amongst what don't change?
the risk premia over equity for these asset classes, and fixed income doesn't change.
Well, fixed income, these are all bad scenarios. So you would expect yields in fixed income to go down, but they've already gone down about as far as they're going to go. So I'm suppressing any joy you might get out of a further rally in fixed income because they're
How about a
already at
deep bear
historic
market?
lows.
How about the opposite, a deep bear market? Like we've seen in the 70s and 80s.
Well, we started with very high notes. We had inflation.
No, but you're starting from 2.25, yes?
Yes. Oh, so have rates go up?
Yeah.
I'm trying to be less depressing than I normally am. If
No,
you raise rates
accuracy
also, you know.
But it's accuracy that matters.
No, it's not accuracy. I would rather be approximately correct than precisely wrong. And I think introducing too much precision at this stage muddies the waters. I would like everyone to be able to focus on what the obvious clear signal is, which is what's going on in equities, and then we can add details later. But attempting to put in details now, I think, muddies the waters. Yes?
Sorry, this may be backing up a bit. I'm just not sure I fully understand the phrase that all analysis performed excluding the actual scenario. I'm not sure what you're referring to when you say all analysis performed and excluding the actual scenario. I'm not sure what analysis you're referring to. I'm sorry, just not grasping the basics there. But what you're referring to when you say the actual scenario.
Yes. And the actuarial, I'm sorry, not actual.
Oh, sorry.
Yeah, so that's everybody grows at 8%. Yeah. For a minute, I thought, what the Trump's name was I trying to say? Because I read the word as actual also. Right? It is actuarial. Yes. Yeah.
So John, if I distill what you're trying to do, you're saying, since all of our risk is equity risk, let's focus on the equity markets and forget the rest.
Yes, essentially.
Right.
They come along for the ride. We can make up what they might or might not do in correlation, but that, to my mind, muddies the waters at the present time.
Okay.
All right. So here's the scenarios. The blue line on top is we grow at 8% every year, and that's good. The line green is the 70s, the stagflation, where we bounce around and end up fairly short. If we repeat the aughts, it's bad. We end up with about half of what we think we're going to have. And if the world turns into Japan, who had their property bubble burst and had decades of very slow growth, it's, I don't know, it's 30 to 90, maybe a third of what we projected. So any of these scenarios are bad for us. Come on.
So the future's rosy.
Yes, yeah, I will leave that to someone else. Certainly, if I put in the 90s, you would see this thing going off the charts. Yeah, there are good decades, as we'll see in the next. So then, in something of a toy model, just to, what's the probability that things, over the past 4 decades, we had 2 great decades, the 80s and the 90s, and in real terms, 2 terrible decades, the 70s and the aughts, where in real inflation-adjusted returns in the equity markets were actually negative, total returns.
Would you say the circumstances, though, in the 70s and the aughts were quite different? Or how would you explain that?
Yeah, I'm not in the common spectrum. Yes, every decade has different circumstances that lead things to come out the way they were. My gut feeling is the circumstances we're in now certainly bear no relationship to the 80s or 90s, just demographically, if nothing else. So I would be stunned if we saw growth at that level. But I'm trying to be agnostic and saying, all right, let's project out 40 years. We randomly get every decade one of those 4 decades. So if we get 3 or 4 80s or 90s in a row, we've done it. If we get 3, decades out of those 4 that look like the 70s or the aughts, it's very bad. Very, very bad.
Well, I was thinking more of defining the aughts. First, what I looked at was malfeasance and corruption caused the markets to be as large as they were in 2000.
No, I would not agree.
Subprime mortgages,
subprime, it was a bubble. Well, I would say.
There are a lot of money to people who couldn't pay mortgages and all of that, and these tranches and things piled up, the garbage.
Yes, it was a bubble, and the tech bubble was a bubble. There's a long history, I think, in our financial system of inflating bubbles, and everyone loves them while the bubble is growing, and then the bubble bursts, and we're all very unhappy. There would have been that bubble if you had saints on Wall Street, because everybody.
I'm waiting for that.
Yes, but if you had saints, it wasn't just Wall Street who thought that subprime mortgages were a wonderful product. The regulators said they were a wonderful product. The rating agencies, everyone. And why were they wonderful? Because they fulfilled a need. And what was that need? For people needed yield. They needed yield that they thought was safe. Partly on one side, you have the need of homeowners. It helps the economy if you can continually refinance your house and take out equity and spend it on things. But it also helped pension funds who were desperately trying to get yield. And pension funds, banks in Europe, everyone who needed yield, here was a product that offered yield and appeared to be safe. It was not safe. But the investors who bought all these tranches, it was insatiable demand for them. Because people needed yield. And one thing that worries me going forward, well, greed everywhere. People, yield hogs are greedy in their own way. But I would argue that the current environment, what scares me about it, is that need for yield has not gone away. It's even worse now, with the year after year of low yield, which means people will stretch to get that yield. We will see, I don't know if it'll be bundling of student loans or something else, but there's another product out there that's going to be flavor of the month, because everything's getting cheap. But at any rate, this is my effort to just put some statistics around what could happen to us over 40 years. So
what was the conclusion of your 40 years?
Well, yes, we have, if at the 8% return, $1 over 40 years grows to $21.70. If we randomly choose decades, good decades, bad decades, the bottom quartile only grows to 5.30. So roughly a 25% chance that we are way behind what we do. We have $5.30 in assets instead of $21. So then some conclusions. I say we can't de-risk the portfolio. People tell me that for over 2 years. But the way I would put it is we can't immunize the portfolio. We can't hide in fixed income securities and match our liabilities because we don't have nearly enough money to do that. The return on them is too low. So we have to. The way you're taking risk, it has a very heavy dependence on the performance of the equity markets because that's historically where returns are. But it gives us a substantial chance of massively underperforming if equity markets do not do what we all hope they will. So the moral of the story is I think there's a need for a lot more flexibility than what we did. I think you're all familiar with the basket clause and how the asset allocation process is constrained. And I would argue maybe there are opportunities in fixed income, but only if we use leverage because the yields are too small on an outright basis. There are many opportunities in derivatives when people are scared and want to buy options. Long-term investors, as Warren Buffett did several years ago, can sell puts. And it sounds scary, but the current portfolio is scary if equity markets don't perform. So my main argument is that we need to be much more open to things that we may traditionally have shied away from because there's a great need to find a way to get more yield in this portfolio.
There's been a spate of articles in the last couple of weeks that I've noticed. I'm making a judgment about the validity, but being critical of private equity, hedge funds, basically what I would lump together as alternative investments. But there really hasn't. It's been a state that they are performing. And as I say, I'm not necessarily giving any credence to it, but I'd like your reaction.
Yeah, it's the old, where are the clients shops, when people are looking at the broker shop, thing. Do the fees, are they there merely to enrich the people pitching the products rather than the products themselves? Look, there are opportunities, there are arbitrages that present themselves in the market, and we can't take advantage of that ourselves. We don't have flexibility or the staff to do it. And the ability to time these things. Occasionally, there are people who, for some period of time, can spin flax into gold working in Wall Street. It doesn't last forever. Eventually, these things go away. But to the extent we have the ability to find people who have an edge and give them money and pay them big fees to take advantage of that edge. And historically, there's been an edge in private equity over public equity, and there's been opportunities in hedge funds. We need to have that flexibility to do it. But yes, they do charge high fees. And if they don't perform the fees, eventually leave you worse off than you might have been. Yes. So I would say.
To John's point, I would tell you that if you look at what we've done the last couple of years, we've moved into things that check some in John's boxes, which is be flexible, right? So we moved into opportunistic fixed income where those managers are nimbler than we are and can move with the opportunities. Hedge funds was an attempt to do the same thing, right? We've dialed down in the asset allocation down from 70% to 65% equities, so that's also directionally correct. We've dialed up a little bit of private equity on the theory that based on all of the work, it's the one asset category that seems to have the highest return based on the projections over the long run that Cal and our other consultants came up, but I think we dialed up a little. But so we have to execute all that, which we're executing on. But I would tell you, as I think John's conclusion is, it's kind of around the edges, If you took this, if you go back to his bar chart and you say, well, 100+% of your risk is equity risk, that's a pretty, and we've had from Cal, I think it was 90, didn't you have 90%?
I think we're in the high 80s. I think we took it down from 90s to the high 80s.
Yeah, we took it from 90s to high 80s. I mean,
different asset classes were included.
And part of that is because high yield was considered fixed income, but the reality is it's more correlated with equity.
The private equity was considered equity.
Yeah. It took it down, but if you think about it, you went from the 80s, 90s to the 80s. That's not like half, right? So you have to do something. You have to turn the whole thing upside down to get to a place that de-risks it. And what always serves to creeps in is when I de-returned it also, particularly now. So it's the reason that we like talking to John is it's interesting, but again, we're not a trading desk. We can't take advantage of it, so we have to have managers that can. And it's all about just trying to go around the edges all the time, and it takes years to wake up and find yourself hopefully in the right spot and not get blown up along the way. Because some of these scenarios that he looks at over 10 years they're bad. They're just bad. And these, to Pat's point, these are just, no matter how you say it, these are just different times. Everyone says, "Oh, it's not different this time." All right. It's not different this time, but it sure as hell ain't the same as it was last year, 5 years ago, 10 years ago, 15 years ago. And there's reversion to mean, all that kind of stuff. But still, we are very big on equities and equities risk. And there are, they're very, very, and we have a simple looking portfolio, so the answer is, well, is complicated better or is it not? So you get this whole fight between active management versus passive management. Are you getting, to your point, are you getting what you paid for? All right, so we'll have a conversation later about active versus passive in one of our asset classes. I don't know, depends. But there are things, again, you're just trying to make it so that you just get rid of some of the volatility and try to get back on track for when times are more normal. These are, I would tell you, we're still in reasonably abnormal times. Not quite sure how long normal is, but this is pretty abnormal coming out of something like '08 and '09 and having interest rates, have the Fed say zero is a good number. Zero's a bad number if you're trying to get to 8, and the Fed's saying I'm at 0. That's a different mathematical equation. It forces you into equities. It forces you into risk. And, if you get forced into risk, there's no safe place. I mean, again, you go back into nicer times, not nicer times, different times, when the risk-free rate is 5, and you're trying to get to 8, I like that better. But when the risk-free rate is 0, to get to 8 is really, really hard. And you really, to do it, taking on a lot of risk. That's 8 points of risk. And you got to have some piece of it in the riskless category. So you might not be able to get there on a short-term basis. You're just trying to get there on a longer-term basis and work it kind of every day with these new managers and, try to move your portfolio around. But again, the key is it's not a daily thing. It's a monthly thing. It doesn't change that much even on a monthly basis. You got to get the bigger picture stuff, I would say, right. Try not to get the big picture wrong.
Are we decoupling our judgments about minimizing risk in the portfolio, or through that, our investment mix, and the need to hit the 8% or the 7%? I'm used to funds which start with the assumption and try to build an investment portfolio around the assumption in order to hit it on a long-term basis.
But are we
really decoupling them?
No, we're not. But when we looked at Callan's assumptions and did our asset allocation, we're trying to get to 8. There was only one number on the page of assumptions, north of 8, and that was private equity.
And emerging markets.
I don't think emerging market equities was north of 8. I think it was like 7.5.
No. Anyway, but both highly risky.
Highly risky at the edge. Every other number is south of 8. So almost any gumbo you put together is going to have a hard time getting to 8 based on the assumptions. Now again, that's built on assumptions. The reality is the Fed's saying 0 is fixed income. That's just a bad day to show up with a model. Right? But you got to do this every day. So you got to position it so that, rates move. How do you get something equity-like? How do you get greater returns without sort of taking on all the risk? One of the answers we conclude is nimbleness. Right? And we're just not nimble as a just can't. So give it to nimble managers. Don't forget, if you give your money to a long-only manager, he's in the market every day, long-only. Right? So the market goes down, you go down. Completely unhedged, not nimble. You give it to an equity guy. I'm in the equities market. Wherever it's going, I'm in the equity market, and you should be happy if I do better by some amount. When the equity market's down, I'm down a little bit less. I look at it and say, I don't want to be down at all. What do you mean down less?
Right.
But that's, everyone manages to a benchmark. So you've got to have some guys that are just absolute return. All I care about is positives. You only pay me on positives. It's better. At least they're thinking the way we're thinking. So it's just, and you can't build, it's $42 billion, right? So we're not nimble. And you just can't sit there on the risk spectrum saying we just have to push risk all the time. So I would tell you there are times when we had this conversation before, do you expect to make 8 every year? And the answer is, you can't make 8 every year. So, a good year last year, a good year the year before, but that was coming off of an atrocious year. So one of the rules, or one of the keys is, try not to have atrocious years, right? The best way to make money is to not lose it on the downside of it. You just have to think about, the world's falling apart, what are we supposed to do about that? Some would say, well, you stick with your asset allocation throughout. Some would say, well, why? Pull some money back, do something else. But that's all, for conversation. We did some of that last fall, right? What's this right? Yes, it cost us something in the short term, but, It cost us something in the short term, but you were trying to de-risk the portfolio. If it kept going down, you would have felt even better. We felt good for a couple of months, then it smacked back up and you missed a little bit, but you were trying to manage risk as opposed to return. You were not smoothly set up to do that. So that's what the managers and those guys charge a lot. Coming back all the way to your original question, people pay them a lot to basically let them try to manage risk better than we can.
Larry, let me come back to a couple of points. One is, when Callan last did the research, 90% of our risk was not just equities, but it was also just beta. And we've now shifted into more idiosyncratic asset classes, so let's say that that risk has gone, but they are less risky asset classes, so let's assume that beta now is about 85% of the portfolio. So we can do everything. BAM can execute at its highest level, but the dominant risk of the portfolio is the beta risk. It's the systematic risk. One of the things that we talked a lot about last year at this time was that there is a way to diversify the beta risk of this portfolio even greater by including inflation-sensitive assets, commodities, timber, other asset classes that we have historically not looked at. Infrastructure plays a role as well. And so, number one, I think we should focus on how do we keep thinking about diversifying our beta risk. Number two, BAM is executing very well on the alpha piece of it, but I feel like we should not take our attention away from the 85% of the risk that drives the variability of our returns, which is the beta. So number one is, let's go back to diversifying our beta risk. Let's go back to that conversation. The second thing I'd like to propose is that we all know where we are. John started his presentation that way, saying, I'm not going to tell you something that you don't know. We have a lot of equity concentration in our portfolio. We also know that de-risking at this point doesn't make sense, largely because of where interest rates are. But how about as a board, the discipline of a plan, the discipline of a 3 to 5 year plan that says to us, you may not do it now, but we should be ready and bear in mind that the bond markets, if they do sell off, I don't know if it's tomorrow, I don't know if it's 4 years from now, I don't know if it's 10 years from now, I have no idea. But give us this sense that we have a strategy to use the very market volatility that in the short term is our enemy, but we stand ready to use it at the right valuation points to actually do even further de-risking into the most liquid, cheapest asset class, TIPS and long-term bonds, which also have been underrepresented in this portfolio. And are underrepresented, by the way, this is not our unique problem. This problem exists in every pension plan. So I would like, as a board, to shift our focus to those two aspects, which is continuing to focus on diversifying the beta risk of our portfolio, even as BAM continues to focus on alpha, which is 15% of the return variability, and to generate a plan so that we can get our heads wrapped around this idea that the market will give us opportunities to invest in the more historically stable asset classes, not very stable for the foreseeable future, but we have a plan. And as you recall, part of the real asset conversation was then to turn to BAM and say, can you please start recruiting for this position so that we can get the much needed education as a board and add the expertise within BAM. You're doing that with infrastructure, but we need to get even infrastructure now correlates so much to real estate itself. It's not necessarily diversifying enough, and it'll take some time to build that up. So I would just like to bring our focus back to those two elements. Diversifying beta, how are we going to do it, and to having this plan over a market cycle.
I would tell you, I agree with what you just said, Ranji, but I would tell you that in the current construct of BAM, I can't execute on what you just said. I can't execute because BAM doesn't have the resources to do it.
So isn't...
Just that simple as, I can come up with every plan. I would tell you opportunistic fixed income is a terrific example. We came up with this plan, we executed the plan, the boards approved the plan, and getting executed has taken months. And I mean months moving into years, because we don't have the staff to match up with these assets.
But you haven't come to us with a proposal. You came to us with a proposal last year. We approved it. You told us that was the staffing you needed to get the plan done. We approved it.
It's a completely... The plan that I came to you with was within a certain set of constraints, and I would tell you that those constraints inhibit the execution of the plan.
We would love to hear about those constraints and help you with it.
Okay, we'll come
And
back.
I think we said that last year.
We'll come back to you shortly, hopefully, with some benchmarking on how our system looks relative to other systems. What's best class? What other people do with our kind of money? What people do with less than our money? But I'm all for making plans, but at the end of the day, you can have a plan you have to execute, and to the extent that we can't execute on a plan, it kind of kills the plan.
But Larry, I'm frustrated to hear you say that, because I think this board has been very open and direct about saying to you, come to us with what you need. If this is what we think as a board that is in the best interest of plan participants, make it our onus to give you that. But if you don't give us that plan, we can't help you. And all I hear is, I don't have what I need to execute what you
We came with a plan. The plan was the right plan. We've been trying to execute the plan, and now here it is, let's call it 9 months later. And we've been unable to execute the plan, and I will come to you with the year-end summary and say, here was the plan, here's what we hired, here's what we didn't hire, here's what we are, let's look at it again. Because again, you have to execute the plan. The plan was perfectly fine with the plan. Again, the plan was also constructed in the constraints that we had as well. So if your question is, well, come to us with something that's unconstrained, which is sort of how we do our asset class analysis, start with unconstrained and put some constraints on it, we'll come to you with an unconstrained or something more unconstrained. But I would tell you, before I come to you with something different, I just think it's important that everybody understand what the comps are. What's everybody doing? Because I just don't think talking to people in a vacuum is useful. Just like when we sit around and talk about almost everything, it's always in the context of the competitive world, markets, environment, what's available, et cetera, et cetera. I think we need to do a little bit of, let's go look at all that. And again, because something we talked about before, which was benchmarking fees, coming up with a benchmarking analysis, it takes a lot of work and a lot of data, because we have a lot of data. But we'll come back to you with that and just kind of look at it and say, all right, that is what it is. And again, as we approach the end of the fiscal year, which is weeks away, we'll come back to you and we had a plan, if we don't plan, if we couldn't execute the following things, and then we'll have a plan for next year. But we'll all be involved in the preparation of the plan.
Larry?
I find it, and maybe you've done it before, but I'm just not capable of holding it in my head, but I would find it very useful to have a clear, comprehensive picture of BAM. Who's there? What do they do? Who does what? In my mind's eye, it's a black box. I don't really have any appreciation for how many people are there. Where's the strengths? Where's the weaknesses? I don't have any of that. And perhaps as part of that presentation, you might want to include something like that.
Right. That presentation was involved in the plan last year.
Right.
It said, here's where BAM was now, here's the boxes we need, they want to improve the boxes because corporate is funding the growth of BAM. But when I come back again, we'll show you, here's what exactly what you want. Here are the asset classes, here's how it works, there's no mystery going on here. Here's what it is. By the way, here's what other people have. And here's what we want to do. Can you kind of get from here's where you are, here's what you want to do, or you can sort of re-engineer the whole machine. Or talk about re-engineering the whole machine and say, look, is that possible, or is it all incremental? And if it's incremental, can you execute the plan? At some point, it does come back. So again, the opportunistic fixed income was very informative to me of good plan, good execution, board approval, not the slow execution. And the slow execution then restricts your ability to execute other things. The plant is filled. Right? I mean,
Why was the slow execution? Just help me catch that one.
I'll help you.
It sounded like everything was teed up.
I'll give you some factoids. So when I got here, Martin, who runs fixed income, had one person working with him. Martin manages $40 billion with him and one person. I would tell you that might be not staffed correctly. Right? But that's just what it was. So we came back to the board and said, we need some more staff in fixed income. Let's make it 5. The board approved it. Had to hire the people. There are some compensation issues with the compensation we can offer relative to does that clear the market. We've now filled the 5 positions. But in the middle of that, we have approved opportunistic fixed income, which is a very complicated designer product. We're literally trying to design joint ventures with these asset managers. So, for instance, one of them ended up with a 100-page document. Well, you give a staff of 2 people and our lawyers a 100-page document to go through, kind of stop the machine. But you couldn't stop the machine because there's other stuff to do. And if you give them 5 or 6 of those, you just gum up the works. At the same time, we have some RFPs, we're trying to do high yield, we're trying to get into other things. It's just not, I would tell you, staffed to manage what we're trying to get done, because I think all the things we're trying to get done are the right things. So it's a little bit, as I've described to some people, is you're trying to take the car from 40 to 60 and change all the tires at the same time. That's just hard. Just hard to do. Not to say, and no one bitched about it. It's just that trying to get this done is the big tanker problem again. I think we should go back to step 1 and say, all right, so if you have this kind of money, and by the way, the $42 billion of NYCERS is inside of $120 billion for the city. Is this thing built right? Because BAM services 5 clients, the 5 pension funds. By the way, they're all a little different.
Right, so the question, thank you. So looking at it, sort of holistically, and $120 billion and all the assets like this NYCERS, how'd you come with 5 versus 10?
So I could get approval. That's all the budgeting process would let you do. It is.
I mean, if you had it unconstrained, you would have said, I need 15 more. Right?
So, David, my question holistically, though, is who's focusing on the 85% risk? We have done a magnificent job. I really commend Larry's team with the resources at hand. Again, constraints that the board should be in a position to remove for you if ever presented with a plan. But with those constraints, a remarkable job on the 15%. As a board, we can't lose sight of the 85% risk. And again, I come back on, there was a position for real assets. These things never work in straight lines. Can you come back to us on risk management, asset allocation? John is a consultant. We are very grateful for Mr. Bright's contributions, but 2 days a week is not full-time risk management for a senior person with a plan with this kind of risk exposure. Very, very scary presentation, very, very realistic presentation. Where are the resources against that problem? Is it systems? Is it people? Is it difficulty hiring people? Where are the resources against against the types of true risk diversifying assets like inflation sensitive assets that we've talked about? Again, truly appreciate the constraints, but how can we help you with that, and how can we understand where you are on that?
We'll come back to you with all that. But again, we want to come back to you with not the needs in a vacuum. Because I think doing it in a vacuum just gets you sometimes vacuous kind of answers. The knee-jerk is no, and it's like, well, all right, before you say no, why don't you just see what we need, and as opposed to us just saying it's a need. See what we're not the only guys with $120 billion. We're not the only, and it's a global competitive market to get returns. So we need to think, we have to be in the world's financial capital. So we've got resources all over the place. So we need to figure out strategically how to match those assets with what we're trying to get done. And then you have your plan for assets, and you have your plan for execution, and you go do it.
Your point is extremely well made and taken to heart. This board has formed a governance committee, and essentially, inherently, what you're talking about is the professionalization of them and doing what it takes to create the compensation and retention structures to attract and retain staff. That's a core governance issue. That's the job of this board to deliver to you. So please take advantage of that initiative from this board to bring these kinds of matters to us. We're having governance people come speak to us. The board has been identifying a few people. I think they're going to speak your talk, talk your talk here, and we got to, as a board, help you walk the walk. So
Okay, thanks.
let's do it.
And I would second that the board, I think for a long time has been ready to go in that direction and provide the necessary resources for them.
Larry?
Yeah, I would, it's always a dangerous thing to say, but I would urge you to not accept the practical political constraints that may inform a plan and come in with something which is much more ideal oriented for
Best
purposes of
practices.
discussion.
That's why I think the benchmarking is interesting, because this is
Right,
it.
Correct.
You can figure out if you have a beer budget or champagne budget.
Correct.
We can all figure that out together with
Right.
the politics of the government, but
Right.
this is what the competition looks like. How do you want to arm ourselves to deal with the competition?
I think that's a good way of doing it.
Okay, any further discussion on this? All right.
Okay, thanks, John.
We have two
There's one other issue.
budgetary issues, et cetera. Carolyn, just kind of lead that discussion.
Right.
Thank you, John.
Good morning, everyone. Are we all here? The first issue we have to discuss is the issue of the law department at investment meetings. This was tabled at the last investment meeting. As you all know, just to summarize, the law department has made a proposal that they attend investment meetings for 1 hour towards the end of the meeting. The mayor's office thinks that's an appropriate compromise, and I've spoken with members of the board and believe there is some support for that proposal. We do have both two borough president representatives out today, Staten Island and Brooklyn, not represented at the meeting. So I'd suggest that we defer a vote on this until the next meeting, but if we'd like to have a discussion, I think that's fine. No? Okay. And then the next issue is the budget. This I tabled from the last regular meeting to look into it a bit further. From the mayor's office perspective, we understand that there was a significant increase in applicants due to the Tier 6 deadline, and that there are implementation costs going forward for NYCERS. However, we think some of the costs that are included in the proposed budget modification relate more to normal operating costs than Tier 6. For example, there's 4 scanners that are being purchased on top of an existing 9. That seems like more of a regular cost of business than a cost related to 13,000 new applicants. But that said, we support the executive director's request for additional funds, and so we're in favor of the budget modification as proposed by the executive director.
I think we need a motion. Should I state the motion, or should I state the resolution?
Sure.
Okay, so as mentioned at the last board meeting, NYCERS is proposing a modification to the budget for fiscal year 2012 in the amount of $285,535, and for the fiscal year 2013, $226,697.
Do we have a motion to approve it? Thank you. And a second? All in favor, please say aye. Aye. Any opposed? Hearing none, the motion carries.
Okay, that's resolution number 1. Thank you, everybody.
That's all of my issues.
Madam Chair, I believe that concludes the public session.
All right.
So if you like, we can make a motion to go into executive session.
I think that's a fine idea, Mr. McTeague. Does anybody like to make a motion to go into executive session? Sure. Thank you. And a second? All in favor? Say aye. Any opposed? Hearing none, motion carries. And we're now in executive session.